folks. Tuesday afternoon, 4 p.m. Must be time for a Barometer Readings webcast. I want to thank everybody for jumping on today. A little bit of a sloppy day today in the market for NASDAQ. S&P was down about 0.8 of 1%. TSX about flat. Interesting, Russell 2000 up on the day. It's been a decent week. We are now into the third week of October, which officially starts the strongest time of the year. As they have often said, sell Rosh Hashanah by Yom Kippur, and we are through both of those dates. In general, as we said, going through September, breadth market-wise has been decent. In fact, it has been strengthening through the course of the past month. So now we're into the strongest time of the year, and we're coming into it with a pretty good backdrop. Lots of diversity in the leadership in the market. Lots of different things working well. Equal weight S&P 500 is performing well. So just quick from the top, the S&P started this bull run way back in 2013 when we exceeded the highs from 2000. We've been working our way higher in fits and starts since then. In the most recent cyclical bear market that ended in January of 2023, actually made the low October 22, exactly 2 years ago. We're now 2 years in. But from the time we make a new high, generally we get 2 to 3 years before we get the next major correction, sort of 20% plus. We're 10 months in, and market is, according to plan, sort of relatively low volatility. And in my opinion, looking forward to the next economic cycle. S&P 500 market cap weighted, the way that people are used to looking at it, made a new high as of yesterday. While Canadians were busy off on Thanksgiving, today giving up about what it gained yesterday, not quite. But we've been moving higher in a pretty orderly stair step, higher highs and higher lows, which is what we like to see. All the moving averages pointing higher. And above everything from the 8-day down to the 200-day moving average. When we look at the equal weight S&P, it's actually a little stronger. Up again today. Last 3 days, boom, boom, boom. Last 2 weeks, we consolidated. We're held at the 8-day moving average, above the 21-day, above the 50-day. And well above this range that it was in through 2022. 23 and into the beginning of 24. When we look at the S&P mid-cap index, I think this is relevant. We've come out of a consolidation that lasted from the end of 2021, November, through the beginning of 2024. These are weekly bars. So over the last 6 weeks, we've been moving smartly higher. We had that 3-week period where we had a big breadth thrust. And we said that 1 month out, it tended to be mixed, but 3 months out, 6 months out, 9 months out, 12 months out, from that type of breadth thrust tends to be the market was higher almost 100% of the time. And we seem to be continuing on to higher highs. When we look at the, actually, this is the small cap index. I should have re-noted this. Also, same kind of picture, 3 great weeks, a little bit of consolidation over the next 4, and 1, 2, 3, 4 weeks higher. So market looks pretty darn good across market caps, across different indices. The one index that continues to lag is the one probably that is the most widely held, and that's the NASDAQ 100. We understand why people are vested here. Lots of great companies involved in important themes that we all think about and talk about, AI and data centers, some of the communications technology, social media, and so on. But the NASDAQ 100 did have a 16% drawdown when the S&P pulled back 10. It has been unable to make new highs since. It's trying, but we're up underneath this range that we were in all the way along, sort of from the August lows, the October lows in 23. Tough day today, down a couple of percent. Looking outside of North America, Nikkei continues to work its way higher. It's just come out of this little consolidation range we've been in over the last few weeks. So I think that that's positive. India continues to be constructive, although at the bottom end of this tight little range. Argentina continuing to work its way higher, and some of the Latin American countries that are benefiting from some of the improvements in basic materials. And the TSX, which we've talked about being more closely associated with global stocks than US stocks because of the big sector weights in financials and industrials and materials and energy. But look, 4 great weekly bars monthly bars as we've come out of this range that we were in while central banks were tightening. So that shows you that across global markets, we have seen a lot of markets participate, a lot of European markets behaving quite well. And the S&P is not the only game in town. In fixed income, we continue to make higher highs and higher lows in yields, turning from a trend which was lower highs and lower lows from 1981 through 2020. Most recently, we pulled back to about 3.8%, and yields have bounced back above 4. Continues to be a tricky market for a bond investor. And we, in our income strategy, we do own some fixed income from time to time. We don't own a lot today outside of what we have to own in our balance mandate. It's hard for us to get excited. This is the 20-year to 30-year US Treasuries ETF, the TLT. And it's about 12% off the lows from October of last year. But in October of last year, it was down 54% over the previous 4 years. When we look at income investments, we continue to think that dividend payers are much more attractive. There's a relative return chart of the FDL Dividend Aristocrats ETF relative to the US Aggregate Bond Index. Again, this week making a new relative high, trading above all the moving averages. So that's dividend payers, and this is dividend growers. RDVY as representative. You can also look at VIG as an example. But really, this has been leading steadily since rates started to rise. And in general, we prefer to own companies that don't need capital, that are generating excess capital, and beyond reinvesting in their businesses, are returning it to shareholders. And importantly, we're looking for companies that are able to raise their dividends on a regular basis. When we look at how things are going in our income strategy since middle of March 23, S&P 500, like the full equity index, up 33%, TSX up 32%, aggregate bond index up about 5.8%, and the XBB, which is this is till last Friday, which is the Canadian bond index, up 4.9%. The income portfolio up almost 36% over that period reflects just the significant outperformance that we're getting out of the dividend growers. And when we put up the sort of the mandate and what we own, in our mandate versus the S&P yield is 1.22%. We're getting almost a full percent higher in dividend. Price earnings multiple in our portfolio is a little below 20 times versus the index up 23 times. So significantly cheaper average. 1-year dividend growth of 34% versus the S&P at 7.6, 3-year dividend growth at 11.7 versus 7, and 5-year dividend growth at 11.4 versus 5% dividend growth. So great rising stream of cash flow, some pretty good outperformance versus the S&P, and significantly cheaper, good risk reward here. And this, I think, continues, as we've said before. If we think that yields can rise over the next 10 to 15 years, which is most likely once you see a generational low, our guess is dividend growth is going to be a theme that's going to be around for a while. On commodities, as we talked about, we're up and out of this little consolidation range that we had. Although, as China pulled back a little over the last 10 days, commodity prices pulled back in a little bit. Not everything, though. Gold continues to be very strong. Trading basically went out at the highs today, up 29% year to date. We think this is the early stage of a new bull market, much like we started in 2005. It went on for 6-7 years. And so we think that we're relatively early stages here. And as we pointed out last week, investors have just started really to add to the GLD ETF after selling the strength over the course of the year, not believing it. Copper, had a nice breakout a couple of weeks ago, pulled back a little over the last 3 days. That's really has been sort of as China's been pulling back. I don't think that that's a negative. We've got nice higher highs and higher lows. So we'll see where we go from here. And at the end of the day, we don't have to be everywhere. Our job is to identify the sort of market leading themes. And that could be sector based, it could be geographically, it could be market caps, different sized companies. We want to focus in the things that have a tailwind. And so the purpose of this webcast is always to review what is it that's working in the market, and are we there? How do our portfolios stack up? We watch for change. We don't want to get too stuck in a view. If a group that has been performing poorly starts to improve, are there some companies within that sector that maybe we should be taking a look at? And in the absence of leadership, should we be sitting on our hands, right? Should we be in cash? So our approach, just to reiterate, is a very tactical approach. The portfolios iterate, they change over time. Sometimes they change fairly quickly if the market goes through a big shift. More often than not, though, we're trying to identify the themes that are going to last over a longer period of time and get focused in them and try and focus in the leading companies, the ones that are taking market share. We're always looking for areas of the market that are seeing more and more stocks perform well. So when you get to the late stages of a down market, generally 2 or 3 of the best companies will have already hit lows and started to improve. And in a healthy market over time, more and more stocks participate. And that's what we want to find. We want to find sectors that are seeing broadening participation. On the other hand, often late in advance, when everybody's bought in, some of the laggards will start to peel away. And it may not be the leading stocks. It may be the ones that people aren't necessarily watching every moment of the day. But if we see deterioration in breadth, that gives us reason to get a little more defensive, tighten up the stop losses that we use on our individual positions, not put any new positions on so long as breadth is contracting. So, I don't need to go through it every week, but it's all about finding areas of the market that are seeing net inflows, and then finding securities within those groups that are good getting better, and then farm this portfolio, be ready to carve out ones that don't work quickly and hold on to the ones that work. And by doing that, if we address getting the right asset class and getting focused on the right sectors, and then finding securities within those sectors that are clearly outperforming their peers, that will take care of, the lion's share of our responsibility. Okay. So last week, we highlighted that breadth across the board in the US and Canada, many countries around the world, certainly Latin America and Asia, we're seeing nice, solid, improving breadth. The percent of stocks in uptrends was expanding. We said in general, the short-term indicators were improving, except for the percent of stocks trading above their 50-day moving average in the US, which had pulled back a little bit. So what's happened since then? Well, first of all, we had a great pickup in consumer confidence. That's key. That's something certainly to watch. We're right into the middle of the earnings reporting period. The week of October 18th, 12% of companies in the S&P report. Next week is the biggest week, with 37% of companies reporting, and then followed by the first week in November. So lots of earnings reports to come. As it stands, we talked about how the Magnificent Seven earnings growth becomes a lot less important, and we start to see contribution over the next few quarters from the rest of the S&P 500 as they come out of some contraction. Now, as we sit today, we are basically at the peak of the buyback blackout period. What does that mean? If companies have announced their intentions to buy back shares as they're going through earnings because they have material information that the market doesn't have, they have to black themselves out around the dates they report because they can't be buying with news that other people don't have. So we're right really at the peak of the buyback blackout, meaning companies slowly start coming back online. And it's important because when we look at the number of share buybacks that have been authorized for this year, this is going to be a record year, almost $1 trillion in buybacks. So we know in the late part of the year, there are companies that do things programmatically, and there are companies that also do more periodic purchases. And we know that generally companies like to go through their budget by the end of the year, which is one of the reasons why the S&P tends to perform well in the fourth quarter. So as we sit today, percent of stocks above the 50-day moving average reversed back up in the US. Virtually all of these indicators showed some improvement over the week, outside of the percent of stocks making new highs versus new lows, which pulled back a small amount in the US, nothing really consequential. So breadth coming into the strongest part of the year is solidly positive. Sentiment is getting better. Earnings estimates for next year are pretty solid. So what are we seeing at the sector level? Financials just continue to march along. These are monthly bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is this year so far. Just solidly marching higher. Now they should do that, given the fact that they came out of a bear market that lasted 14 years. And they had a first leg higher when we went through the central bank's tightening. The market started looking beyond it well before. Now, one of the things we talked about over the last 18 months is that in 2020, we saw the end of close to a 40-year period where the borrower was in control because of the falling cost of capital, to a period now over the last 4 years where we're seeing rising interest rates and where likely the lender is in control. Well, that's interesting. When we got the earnings reports this week, JP Morgan had great numbers across the board. They beat on their net interest margins, the difference between what they're lending at versus what they're paying on deposits. Even though they cautioned a little bit intra-quarter, they came in with a good number. Bank of America came in line with net interest margins, but very strong trading revenues, and had good numbers. Goldman Sachs, really strong trading revenues and good investment banking beat. There was nothing that was negative about this number. Diamond, for the first time in several quarters at JP Morgan, was positive on the US economy, even though he had some caution on some of global markets. So what's happening from a sector perspective? Well, first of all, this is the XLF again underneath a microscope. It's just marching its way higher, up 49% since 2021 when it broke out, but we think still relatively early days. The insurance sector, which we've been in all year long, trading better than 81% of companies in the S&P, had 5 great days against a market that was not up nearly that much. That probably is the response to the impact of the hurricane that hit Florida, which turned out not to create as much damage as was expected. When we look at the Canadian insurance companies, Intact Financial, which I don't talk about a lot, has had a great 3 days, going out at a new all-time high today. Fairfax has continued to march along, and certainly Manulife, which we've been focused on, life insurers, performing really, really well. We highlighted last week the capital markets banks and said it is unlikely that these companies will disappoint, given the fact that they were basically trading at new 52-week highs coming into earnings. Look at the pickup in relative price strength over the past week. So really great performance in this list of companies. JP Morgan making a new high, Goldman Sachs making a new high, Bank of America trading up nicely after the numbers. This group continues to behave really well, and we think gives us great risk reward. Remember, most of these companies are trading 10, 11 times earnings. These are not 20 and 25 times earnings, and we're getting a nice pickup in earnings. The equally weighted Canadian banks, which had been consolidating through the last couple of weeks, went out at a new high today. Companies like Commerce Bank, which is a big holding for us, National Bank, and Royal Bank all making 52-week highs. So financials continue to perform well. 25% of firm assets are in financials, and we think the group is just still generally underweighted and underappreciated. Industrials went out at a new high today. The defense sector has been very strong, trading better than 85% of companies, and you can imagine why. We've talked about Howmet Aerospace, better than 97% of stocks in the S&P in the last year, and BWX, which we highlighted last week, in the nuclear power area, 91%, trading better than 91% of companies. You may have seen Google announced an agreement to buy small nuclear reactors from a company called Kairos Power. Surprising, this is a company that has not got any installations, but they do have an interesting technology to use liquid salt to cool the reactors. but they won't be online between 2030. BWX is in production now and doing significant work with Ontario Power Generation. Infrastructure in general continues to behave exceedingly well. And when people ask about the election, what does better, what does worse? Our thoughts have been that in general, small mid-cap stocks probably do a little better under Trump, a little bit more protectionism, a little bit less regulation, and under Kamala Harris presidency, infrastructure probably continues to do well. But realistically, hard to imagine that there won't be a lot of spending on infrastructure with all the power needs that are going to come out of the data center industry. So that's why this WSP is performing so well. They recently bought a large engineering business in the US that's focused on, consulting in the power generation industry. So industrials keep on trucking along. SNC, the old SNC Lavalin, Atkins Realis, rebranded for obvious reasons, went out today at a new 52-week high and just breaking out technically. So this is a great group. Materials marched higher over the course of the last week. We had some of the golds pull back a little bit over the last 2 weeks. They've been firming up nicely. And as I highlighted last week, gold still makes up a very small percent very small percent of investable assets, and we think can go up a bunch. The energy sector, XEG, trading just below breaking out, but the ZEO, which is the ETF equally weighted in the 10 large long life energy assets in Canada, broke out last week. And we think looks really, really attractive. We've talked a lot about Suncor and Imperial Oil and Canadian Natural Resources. The one thing we do want to keep in mind is on some of the Middle East tensions, there was a ton of people who were buying calls on oil, expecting some kind of a spike if Israel was to strike back at Iranian oil interests. We do have to keep in mind, though, that the US is a lot less dependent on Middle Eastern oil today than they used to be. So we'll see how that plays out. In communications continues to be a strong group, not because of phone companies, but because of companies like Meta and Google. We really only have 2 positions here. We've got a good sized position in Meta, trading better than 93% of companies, just having broken out of a very nice consolidation. And Motorola Solutions, which we talked about a while ago, I haven't brought up for a little while, is trading better than 92% of companies in the S&P. Very strong relative strength, really nice earnings growth, really nice cash flow growth. And this company sells cameras that are used by police departments to capture real-time footage. And of course, they're selling into all kinds of the police departments across North America. Now, back to the defensives for a minute. The TLT, the bond ETF, did sell off quite a lot over the last month and a half. In fact, about 10%. And while that sold off, the defensive sectors, the high dividend payers, did pull back a little bit. This is the REIT index in the US, pulled right back to the moving average. But as usual, if you high grade in the strongest companies, you tend to do a little better. And our big weight is Simon Property Group, which had a very strong day today and went out at a new 52-week high. In the utilities did pull back a little bit, but Southern Company has been able to hold its gains, trading better than 84% of stocks in the S&P. Of course, that's partly because it has the nuclear power plant that opened in Georgia over the past 18 months. And is providing a little extra dividend growth and a little extra earnings growth. In the consumer, it's hard to get excited. Although our 2 biggest holdings would be Uber Technologies, which had a really good week. Earnings get reported in about 2 weeks, and obviously expectations are strong. They had a good response in the past week when Tesla's robo-taxis came along with a start date that was probably longer than what people expected, and Dollarama, which just continues to climb. This has been a great holding. We've owned this for almost 2 years now, and it's just working its way higher. They got lots of growth opportunity. So there's a lot of things that are working. Now, one of the groups that's still a question mark for us is technology, a huge outperformer over the last couple of years, although on a relative basis, sort of lagging over the last 6 months. Had a tough day today, down 1.9%. We continue to have a very small weight, about 12% versus the S&P, close to 30. And part of the reason is that the top 10 companies in the S&P, a lot of them tech related, continue to be a very high concentration in the market. And historically speaking, that's not been a great thing going forwards. So Broadcom has performed really well, and despite a weak day for semis today, down about 3%. ASML, which is the largest company in Europe, a semiconductor equipment manufacturer, accidentally sent its earnings out this morning, and with it, a warning that next quarter will be weaker, meaning that they'll sell less semiconductor manufacturing equipment. That took its stock down 18%. The semi sector was down a little over 5.8%. Broadcom and NVIDIA actually hung in very, very well relative to that, but we're relatively cautious there. We talked last week about the software sector broke out to new highs. It held in very well, and the cybersecurity sector held in as well. On healthcare's relative strength continues to be weak. We can continue to have very low weight there. We do have a position in Lilly, which has been a strong performer. But in general, we think politically, this is a group that continues to be under pressure. So we put it all together. We had a lot of sectors with capital letters here, which means breadth is expanding in every one of them. Healthcare is an exception. Waste is an exception. Regional banks, savings and loans are an exception. But in general, our focus has been in sectors that have more broad-based rallies, those that are gaining breadth more readily than the weaker sectors. And our sector weights haven't changed a lot. So across the firm, we continue to be actually almost 26% financials versus a month ago 24, and versus the index, the S&P 12%. Technology grew a little over the month as we put our NVIDIA position back on. Industrials is a significant overweight. Energy is a significant overweight, although, we're less than where we were a month ago. We need to see, this breakout follow through. We've got a good weight in materials, about a 3.5 times weight of the index. Staples is an underweight, as is consumer discretionary, but this is where Loblaws and Dollarama fits in. Healthcare, a very low weight. Communication services, an underweight because we really have no telecom exposure. Utilities are a slight overweight, and REITs are basically in line. So it's a portfolio that is leaning toward the next business cycle. Industrials, financials, materials, they're more economically sensitive. We've got some great dividend growth in the portfolios. And we look at how things are going year to date. Equal weight S&P is up 15, TSX up 19. So TSX is outperforming. The bond index up 2.5. Income portfolio is up almost 22%. Equity portfolio is up 19.3, and the global portfolio up 21.8. Since the middle of March, 18 months ago, equal weight S up 33%, TSX up 32, bond index up 4.9. The income portfolio is up almost 36%. Equity portfolio is up just under 40, and the global portfolio is up at just under 40. So very pleased with the progress that the team is making. Really pleased with the portfolio makeup. You got to keep in mind that we're into a liquidity cycle, and that's a good thing for equities. I can't stress that enough. Equities like liquidity. Credit spreads continue to come down, so bond investors are demanding less premium to take credit risk. That means they're not worried about some kind of meltdown. And credit spreads are about as narrow as they ever get. These tend to be at times when things are pretty good. Volatility is in the range that we tend to see during a cyclical bull market. And I think we got some room to go. So how much room do we think this can go? Well, every bull market is different, but they tend to last a fair length of time, on average 5.5 years. If we measure from the bottom of the last bear market, we're 2 years. And it's not impossible that could be it. I don't see any sign of that being the case. We do think that we're in a longer term bull market. And when we quantify it and look at the length of the current bull market, things can run a long way. So we're not going to try and extrapolate. Our job is to be disciplined, to measure, to have things that are quantitative to help us make decisions. And all of the tools that we're using right now would say we think we're in the right spots. So we move forward, we look for signs of change. And if we see them, you'll see them, because I got to put them up on the screen. If things get more difficult, we do have a tendency to get more defensive. We're pretty good at playing defense in a tough market, but we really don't see signs of the need to do that currently. So you should always be careful, because you never know what you're going to get next. But as it sits right now, we think that the risks are skewed in our favor. Don't hesitate to watch us on @Barometer CA on Twitter. I keep putting up stuff weekly. And let's see if we got any questions. Question from Stephen: did NVIDIA only go into the equity pools or other pools as well? So we started with it in the equity pool, and we have started with it in a few of the separately managed accounts. So not all the mandates, the equity mandate, yes. And we'll see. We always start with a partial position, and if it continues on, we'll add to it. We want to make sure that technically it continues to be sound, and we'll pick our spots. Brian, what is our view on Bitcoin now? Well, that's a timely question. Let me see if I can put it up on the screen. I actually put a tweet up on Twitter today. Let's see if I can share it with you. So let's see if I can share. Okay, so let's start with a very long-term picture. So this is a monthly picture of Bitcoin back to 2012. And what you can see is it's been a series of stair steps. A 9,000% move, 2012 through 14, then sideways. And it was sideways from, December of 2013 to January of 17, 4 years. And then you had a very solid move coming out there. In fact, up 1,700% from February of 2017 through the highs reached in December of 2017. And he went sideways from December of 17 through November 2020. And then you had another solid move. Let's see here. Hold on. I'm trying to look behind my camera here. There we go. 395%. And then we traded in a range from 2021 April through until March of 24. Now, in this case, Bitcoin broke out and traded sideways. Now let's look at this on a shorter term perspective. There we go. So traded in a range, a lot like the range some commodities were in March of 24 through October of 24. But when we look at it on a daily basis, it's just poking its head out of this range. So my guess is we are likely headed higher. It should trade with liquidity. Increased liquidity in the market should be supportive. I think it's also interesting if we compare it versus the equally weighted S&P. Now, again, I'm not a Bitcoin bug, but I like to look at charts, and sometimes charts are very orderly. So this is a relative strength chart of Bitcoin versus the equally weighted S&P, and I posted this today as well. And it just looks like it's coming out of this consolidation range. So my guess is that it's very possible we are starting into a new leg higher in Bitcoin. Remember that some of the buyers of Bitcoin are in the US, but there's a lot of buyers in Bitcoin that live in countries where the currency is a lot less stable, where there's more inflation, where there's less rule of law. And, this is seen by many people as a store of value. So one thing I will say is when a stock or a security consolidates in a very narrow range over an extended period of time, when it breaks out, it can have a sharp move higher. So we do have about a 7% weight in our macro portfolio. And that's on top of the precious metals weight that we have currently. I think it's a diversifier, and it is becoming an institutionalized assets. When Larry Fink at BlackRock says he thinks that it could wind up being an asset class bigger than the U.S. housing asset class, that's a statement. So we'll see. It's one security, but I have a fairly positive view. And I think that's all the questions we got. Okay. If there are questions I'm not answering that you'd like an answer to, please give me a call. Don't hesitate to reach out. We're going to keep doing these every week because we're getting a great response and I find them useful. It's great when I get to talk to people and they got a good idea of what we're doing to begin with. Winds up being a more personal conversation. If you are wondering about whether you're doing the right things in your portfolio, we're always happy to have a conversation. That's what we're here for. So thanks so much for tuning in, and we'll look forward to seeing you all again next week. See you, folks.